Good afternoon and welcome to this ACT webinar on money market reform and what this means for treasurers. As we enter the final months before the implementation of the new European money market regulations, asset managers are beginning to announce their transition plans, outlining what type and range of funds they'll be launching later in the year. As investors in money market funds, corporate treasurers would need to make some key decisions over the next few months. But what are the key considerations and pitfalls that treasurers should be looking out for? I'm Michelle Price and I work in the policy and technical team here at the ACT. But before we get started, there are a few technical points about the webinar setup for those of you who have not joined us before. There is a menu bar across the bottom that allows you to open various windows, and you can move around your screen, resize them or minimize them. The yellow button with a question mark is for help if you have any technical difficulties. The green resource box is where you can download further information about this webinar and other events at the ACT calendar. Most importantly, the purple Q&A widget opens the new window. You can send us questions to us by typing in that window. Please don't wait until the end to send them in. Just send them in as they occur to you. And we'll try and make this webinar as interactive as possible. And I can actually see I'm already getting some questions in, so thank you. A recording of this webinar will be available on the ACT website in a couple of days' time. Today I'm delighted to welcome Alistair Sewell, Senior Director at Fitch Ratings Fund, an asset manager group for EMEA and APAC. In this role, he's ultimately responsible for all of Fitch's funds and asset management rating activities across these regions, covering all asset classes. Alistair also drives Fitch's asset management research agenda and is a frequent commentator on topical industry trends and developments. You may have noticed that Jane Pilcher was also mentioned on the program. However, unfortunately, due to personal circumstances, Jane is unable to join us today. We're going to spend the next 40 minutes or so discussing money market fund reform and what it means for treasurers in practice. While we touch on some of the basics, the intention of this webinar is to discuss the more detailed aspects of the reform that the treasurers need to understand. Alistair's kindly pulled a presentation together to talk us through this, and Alistair, I'll hand over to you.
Thank you, Michelle. So let's get started. So as Michelle mentioned, I'm Alistair Sewell and I'm in charge of the Fund and Asset Manager Rating Group at Fitch for EMEA and Asia Pacific. And I spend a very great deal of my time looking at money market funds and indeed European money market fund reform, which is a key issue for all corporate treasurers today. In the presentation today, we're going to go through a number of different points. So first of all, we're going to have a short video and a short discussion on what's going to happen, what the timeline for reform will be. We'll then go into the more detailed technical discussion of what the characteristics of the reforms are and what the risks that we see in products are. And then we will move on to a discussion of what the reforms will mean for treasurers before wrapping up. Now, I understand that there is a facility for asking questions. We would invite you to ask questions along the way and at the end as well. And Michelle will be curating those questions for us, and we may well answer a few of those as we go through the presentation. So let's move on to our first section, and we're going to begin by showing you a short video on the timeline and what's going to happen next for the reforms.
European money fund reform is coming. All new funds launched after 21st of July. European money fund reform is coming. All new funds launched after 21st of July of this year will need to comply with the reforms. All existing funds will need to convert into one of the formats prescribed by the reforms by 21st of January of next year at the latest. So that gives roughly 3 months for new funds and 9 months at the very longest for existing funds. Currently, investors have three broad types of funds available to them: short-term constant net asset value, or CNAV funds, short-term variable net asset value, or VNAV funds, and standard VNAV funds. Post-reform, the investment bandwidth of the CNAV funds will be limited to government securities only. This contrasts with today's CNAVs, which can invest in a range of government and non-government securities. Short-term and standard VNAVs will continue to exist in a broadly comparable format to today's funds, with some minor differences. The reforms will introduce a new fund type, the Low Volatility Net Asset Value, or LVNAV fund, which sits somewhere between future CNAV and VNAV funds. From a rating perspective, the overall structure is not the key rating driver. Rather, it's the risk profile of the fund which matters. Conceptually, we can rate CNAVs, LVNAVs, and short-term VNAVs at the AAA MMF rating level. The advent of the LVNAV fund type is significant. We anticipate it becoming the most popular fund type in Europe overall, post-reform.
Okay, so with that video we talked a little bit about the reform process and the timeline to go. And one question that often comes to us is how will the European reform process compare with Europe? And one of the key characteristics we saw in the US money fund reform process, which concluded in October of 2016, is that there was a high late surge of funds moving from the so-called prime funds in the US into government funds, with eventually a very significant shift of assets. And much of that happened in the very last few months of the reform process over there. So what we've done with this slide is to essentially take the flow curve in the US. So here we're plotting the percentage of the total flow that occurred over time. And we've applied that to, from today, essentially, to the end of the reform period in Europe, which ends in January of 2019.
So looking at that, Alistair, it looks like treasurers are going to have a very, very busy Christmas?
Well, on the face of it, yes. I mean, that's exactly what happened in the US. The final 2 months of the reform process there were where the majority of the action took place in terms of fund transitions and fund movements. Now, in Europe, we are anticipating a different outcome. And one of the reasons for that is, as you point out, it's Christmas time.
Yeah.
That falls right in the middle. So we understand that a number of the custodial banks that provide custodial services to the money market funds have announced blackout periods across the transition period. And we also understand that there is some reticence, or perhaps even some blackout periods from some regulators in terms of approving new funds for launch, again covering that Christmas period. So for Europe, we are anticipating that period, let's say those few weeks around Christmas, we're expecting them to be taken out of the equation. So the curve is going to look different to this in Europe, and we're pretty certain about that. What we have heard from the fund providers is that the peak of transitions, or the majority, or the largest part we've heard to date, anticipate transitioning their funds in or around the fourth quarter of this year, with October in particular being a frequently referenced month for transitioning to one or more of the new fund types.
So at our recent cash management conference, the ACT conference, I spoke to a few fund managers, and they were in the process of publicly announcing what types of funds they were going to have. But have any actually been established yet?
Well, we understand that the asset managers are actively setting up the funds now. There are certain activities they need to go through to make that happen. They need to seek regulatory approvals. They need to make changes to documentations. And we understand that those processes are well underway. And that most of the fund managers have pretty well staffed, pretty significant process and transition management teams which are looking into European reform. A lot of them are taking the experience they had in the US of going through a reform process and using those project teams again in Europe. So this is all underway. We have not seen any launches of any of the new fund types as yet. But as I said, we're expecting the second half of this year, and in particular the fourth quarter in October, and it going a little closer, to be a busy time for fund conversions and fund transitions.
Okay, thank you.
So that gives you an overview of what's going to happen next. So now let's turn to the funds themselves, and let's talk a little bit about some of their characteristics, some of their risks, and some of the probabilities we see for those risks. Okay, so first of all, the low volatility net asset value fund. Now these funds have had quite a lot of attention because of one of the specific features they have, which is their ability to apply liquidity fees or redemption gates, with the redemption gate being a mechanism for stopping redemptions from the fund, and the liquidity fee being a mechanism to apply a fee for withdrawing money from the fund. The regulations have some fairly specific guidance on this matter, and what we've tried to show in this slide is at a high level is the process that a fund has to follow in terms of applying these liquidity fees or redemption gates. It's a three-step test. So in the first step, it's a discretionary step, and I really want to emphasize that. This is a discretionary point. So in this step one, the board of directors of the fund has the discretion over whether to apply a liquidity fee, a redemption gate, or it has full authority to choose to do nothing. It has a fiduciary responsibility to act in investors' best interests, and it may well conclude that it is in investors' best interest to not apply a liquidity fee or a redemption gate. Now, the specific test that the fund has to undertake is if weekly liquidity in the fund, as calculated under the regulations, and we'll come on to that, falls below 30%. And I'm going to stress that again, that is and there is a daily net redemption of in excess of 10%, then at that point the fund's board of directors needs to consider applying the liquidity fee or redemption gate. Important point there, that makes it a joint probability event. And whilst these two factors, liquidity levels and outflows, are certainly correlated, it does remain a joint probability event, which we'll come back to. Now, if we move on to step two, what happens here is if weekly liquidity falls below 10%, which is significantly below the 30% threshold for the discretionary test, then at that point the board of directors of the fund is obliged to apply either a redemption gate or a liquidity fee. So again, that's worth emphasizing. There is still discretion here on the part of the board. It may conclude that the suspension of redemption is in investors' best interest. It may also conclude that a liquidity fee, which it also has the discretion over the sizing of that fee, is the appropriate action. And then we move on to the third step. Now here, if there is redemption suspension of more than 15 days in any 90-day period, then at that point the LVNAV fund will be forced to move to a VNAV fund, to a full VNAV fund. So this is a three-step test.
Alistair, sorry, to what extent do these liquidity fees and gates already exist in what I would call the old style, current funds?
Current funds, in fact, all UCITS funds have a smorgasbord of extraordinary liquidity management techniques available to them, which range from in specie or in-kind redemptions for certain classes of investors, through gates, through fees, through emergency borrowing if they need be. And the vast majority of European money market funds are UCITS, so they already have the ability to apply liquidity fees and redemption gates. And if you have the time, and we have, and we do, to look into the depths of the prospectuses of these funds, you will find that there are all kinds of circumstances in which a fund's board of directors could, on a discretionary basis, apply a liquidity fee or a redemption gate within its fiduciary responsibility to act in the best interest of investors. What the reforms have done, or will be doing when they become fully effective in January of next year, is introducing really quite objective triggers for board consideration of liquidity fees and gates, which is something we saw in the US reform process as well. So whilst liquidity fees and redemption gates have always been there in money market funds, and they will still be there under the UCITS rules, there's also an additional layer of quite specific and objective triggers for liquidity fees and redemption gates now.
So the so what for a corporate treasurer is really understanding how different these regulatory gates and fees are to their current practice.
Yeah, I think so. They've certainly gained a lot of attention, but I think it's important to be mindful of the risk here, and to be mindful of the likelihood that any of these would actually be applied. And there are several factors affecting that, which provides a beautiful segue to my next slide. So what we can see here is we looked at all of the funds in our rated universe. This was at some point last year, and to be fair, this makes the test really quite unfair here, in that this is before the funds have made any adaptation to the reforms to perhaps boost liquidity or change their composition. So it's an unfair comparison, but it is a snapshot. And what we did here is we recalculated the liquidity levels of all of these funds, applying the rules set out in the European reforms. And one of the key points I'd highlight is that even without the funds making any adjustments to their portfolios to accommodate the reforms, you can see that the vast majority have liquidity in excess of that 30% discretionary threshold level, and all of them have significantly more liquidity than that mandatory threshold. See, these are rated funds, and we as a rating agency have specific requirements on liquidity levels, so that's clearly a factor. But what is important to highlight here is that even before funds have begun adapting and adjusting portfolios to accommodate the reforms, they have high liquidity levels.
Someone's asking one of the questions, how is weekly liquidity defined?
Yeah, so weekly liquidity comprises securities which are maturing within a week. That's what we would call natural weekly liquidity, and you can see that in the blue on the chart here. But there are certain securities which are considered eligible to be included in the weekly liquidity calculation under the reforms, and those will include things like certain government securities with certain maturity levels on them, certain agency securities. There is a fairly finite list of these types of securities which the reforms consider essentially liquid, even in stressed market conditions, and that therefore can be included in that count towards weekly liquidity. Worth mentioning that our rating criteria and what we consider eligible for weekly liquidity is slightly different to what the reforms would consider in certain areas. But the key difference there is natural liquidity is what's maturing within a week, and eligible includes certain securities which would conceptually be realizable in a stressed market environment. So let's now take a look at the probability of a liquidity fee or redemption gate being applied. And here I'm focusing on the discretionary liquidity fee or redemption gate, which is the trigger for that is liquidity falling below 30% and a net outflow of more than 10%. So as I mentioned, that makes it a joint probability event. And what you can see here is the histogram, which is a beautiful, almost perfect normal distribution. My contact details are at the end of the presentation, so if you want to come back to me to discuss the third and fourth moments of this distribution afterwards, I'd be delighted to do so. The point being here that a net outflow of more than 10% is an extremely rare occurrence, and a fall below 30% weekly liquidity is also extremely rare. Let me caveat this. Number one, it's historic data. Number two, it's data that we took readings over the last 5 years. So we have an enormous number of readings, but we fully recognise that this was a benign period.
On that point, I mean, given it is the last 5 years, it doesn't cover the global financial crisis. I mean, was there a run on funds in the last crisis?
So the crisis certainly had a significant effect on funds, and there were obviously some instances of funds breaking the buck related to events at Lehman, which was almost 10 years ago. But what it is important to say is that the composition of funds has radically changed from pre-crisis to now. So the funds pre-crisis were able to invest in asset classes that really would not be possible to invest in, simply because, quite frankly, some of these instruments don't exist anymore. But also the reform process that has already taken place has restricted money market funds. The prudent investment guidelines and investment management strategies that fund managers now adopt have also made these funds significantly more conservative than they were pre-crisis. So these funds are being managed in a fundamentally different way, and the reforms will certainly add further change to the way some of these funds are managed. Particularly, we would anticipate funds running with even higher liquidity levels than they do now, in part to react to investor sensitivity around this unlikely situation in which a gate or a fee were applied.
So the next crisis is going to be different.
Absolutely. So now let's change focus slightly and let's talk about the other feature of an LVNAV. And what we have here is the pricing of LVNAVs. So if an LVNAV, if its mark-to-market price differs by more than 20 basis points with its book value, essentially price, then it moves to variable pricing. Now, there's a little technicality that I want to highlight here, is that the funds don't actually change type. So an LVNAV can theoretically move to variable pricing, but it remains an LVNAV, even though it would be pricing on a variable basis. That's important to emphasize. It does not change into a new fund type. It remains an LVNAV, but it becomes an LVNAV with variable pricing. If the mark-to-market price moves back closer to the book value, so within that 20 basis point collar, then it will move back to being a stable pricing LVNAV. So that's quite an important distinction to make. So the question then becomes, well, just how likely is that? So here we have, and I would call this a preliminary study. We are actively working on this, and as Michelle mentioned at the beginning, there are, in the resources box on your screen, there are some research reports available. There's one which digs into our study on gate and fee probability in more detail, and we also have some work forthcoming on mark-to-market volatility in these funds. But what you can see here is our preliminary study on this, and you can, first of all, let me highlight the vertical axis. You can see that only goes up and down by 10 basis points. So remember that the collar is 20 basis points. What I'm showing here is half of that. And even within that, you can see that the actual variation, the mark-to-market variation in pricing is extremely low. I think the largest movement we've seen is roughly five and a bit basis points. So this is very, very low movement. Again, it's over a fairly benign period, but taking into consideration the conservative strategy the funds are following, we think it is fairly unlikely that the collar will be breached.
So Alistair, you mentioned an LVNAV, when it hits the corridor, it remains as an LVNAV, but with variable pricing. Is there ever an instance where it is forced to move into a VNAV?
Yes, there is. So if we look to the earlier slide, I'm just going to bring up on the screen now. So here, if we look at step 3 on this chart, so we have step 1, which is the discretionary trigger. We have step 2, which is the mandatory trigger. At step 3, at this point, if there's been a redemption suspension in total of 15 days or more in any 90-day period, then at that point, the LVNAV will cease to be an LVNAV, yep, and it will become a VNAV, presumably a short-term VNAV fund at that point. That's a specific requirement. When it comes to pricing, the fund remains an LVNAV, but the price can vary.
Okay. But we would hope that's in a very extreme situation.
We would think that would be a highly unlikely situation. So let's now turn to the final part of our presentation, which is to talk a little bit about what the reforms are actually going to mean for corporate treasurers. And here, I know we've been having some questions along the way, but we actually thought we would ask you a question. So with that, we're going to turn to a voting slide. And the question here is, what will be your preferred option post-reform? So the options there are the public debt CNAV, which is the fund which can primarily only invest in government securities, the LVNAV, or low volatility net asset value fund, short-term VNAV funds, standard VNAV funds, so these are funds which can invest for slightly longer maturity profiles than the short-term funds, a combination of different money fund types, other options, or I grudgingly included the gimme option, which is we haven't decided yet.
While we're asking, while people are thinking about that, one of the questions that's come in is, what is the expected size of the various reformed funds? Corporate treasury policies often have a limit set at a certain percentage of fund size and might run into issues if the fund size is smaller. Any thought, well, actually you might want to answer it after you get the the answers in.
Let's maybe move to the next slide, which I think will show us the results. Okay. So that's interesting. We have a winner. LVNAV seems to be the winner. And actually, this is interesting because when we compare this result with other surveys that we've run of investors, we've also had the result coming back that LVNAV will be the most popular option for corporate treasurers post-reform. But going back to the question that came in on
fund size, yeah.
So we are anticipating some flows in the industry, but actually we're not expecting, outside of euros perhaps, and euros are a very specific consideration which we'll probably be able to come back to. We are actually expecting outflows broadly from the industry in Europe, and this is related to US tax reform, where we are aware of major multinational corporates planning to repatriate offshore cash onshore. And a good example of that is Honeywell has announced that it will be repatriating $7 billion of its $11 billion in offshore cash to the US over the next over the course of 2018 and 2019. I should stress that is information in the public domain. And anecdotally, we've heard some funds reporting of US cash repatriation-related flows. Interestingly, we can't actually see it in the data yet when we look at the flows on money market funds, but so we suspect it will be a gradual movement rather than any severe stress. But broadly speaking, we don't expect major reform-driven flows out of the industry. So on that basis, we would anticipate funds being able to maintain fairly stable size, which would mitigate the risk of the automatic redemption from a fund based on size limitations. Obviously, depending on the size of the fund, depending on the size of the corporate cash that's invested in the fund.
But worth a treasurer asking their fund manager, as well.
Oh, absolutely. I would encourage all corporate treasurers to actively reach out to their fund managers to understand the fund ranges that the fund manager has, to understand how they see the risk, because the fund manager may have a different view on some of these matters to our view. But it's important to reach out and to really make sure you understand the reforms, you understand what your providers are going to be doing for you. Okay, so this is great. And in fact, it brings me on to the next slide, which is decision time is fast approaching. In our video, we mentioned that there are 9 months till the reforms are effective for existing funds. They become effective for new funds from July of this year. So decision time really is fast approaching. And so we see three important steps for all corporate treasurers to take. So number one, to understand the reforms, to understand the operational issues, to understand the accounting issues, to understand the way that we as a rating agency will approach the reforms and indeed the post-reform fund lineups. Then to update your investment policy, to dig out your investment policy and ensure it is still fit for purpose, that it can accommodate the reforms and that fundamentally it's still doing what you want it to do, and that it is appropriate and balanced for today and for the new paradigm that will exist post-reform. If investors are considering variable net asset value funds and they haven't used them before, that would imply that some system changes may be needed. There may be system changes needed in any case, simply to adapt to the new varieties of funds available. And then finally, well, it's decision time. Corporate treasurers need to identify the types of funds they want to have exposure to. They may need to vote in extraordinary general meetings. They may not, it depends. And lastly, they actually need to vote with their feet. They need
make a decision.
make a decision. Move money into the funds that they find are suitable for their investment policy, are suitable for their needs, and invest in those.
Also, a few questions coming in on accounting. What is the current corporate treasurer's approach to the treatment of cash and cash equivalents with their auditors? And another one coming in, if corporates move to a LVNAV fund or a VNAV, will the accounting treatment remain the same? So obviously a concern to treasurers out there. What are your thoughts?
Yeah, so just before answering that, I'm just going to flick forward to our next slide, which is actually another part from our recent survey. Just to highlight here, you can see that back in 2016, corporate treasurers were more focused on kind of headline issues, so the floating NAV point you can see was significant in 2016, came down a lot in 2017. But what's really gone up in terms of what's front of mind for corporate treasurers from our survey is operational and accounting issues, which resonate strongly with that question that came in. So to answer that, in terms of the accounting treatment, well, obviously, let's take the first caveat. That is a discussion that you need to have with your accountants to understand exactly how they will treat that in relation to you. We understand that there is some variation in treatment across jurisdictions in Europe and potentially across auditor as well. So that is a question for you to discuss with your auditor. In most cases, we understand today that money market funds are considered part of cash and cash equivalent. Post-reform, I can certainly speak to the way that we as a rating agency will look at a corporate balance sheet, and I can say definitively that post-reform we will consider low volatility net asset value, LVNAV, funds, cash and cash equivalent for the purposes of the calculation of downstream metrics which form part of our rating criteria. So for us, looking at the risk posed by these funds and looking at the characteristics of these funds, we as a rating agency will certainly be considering them cash and cash equivalent.
Okay, that's good to hear. Let's get the accounting firms on board. Slightly digressing, but a question coming in. Is there any danger of any future different interpretation of this reform? And they're saying, i.e. from EU members, French, German, or other bodies, ESMA, etc.
So the reforms were written in as a regulation, which means that they apply directly in national law in the EU. So that should mean that the level of discretion of the, let's say, the national competent authorities is limited, at least at the level 1. So there should be very little different treatment by jurisdiction in Europe. On the level 2, and some of you may have heard that ESMA has published some technical guidance on the reforms. In December of last year, there was also some further commentary from ESMA just in the last couple of days on this point as well. I would urge you all to review that source documentation as well as discuss it with us as a rating agency. We are always available to discuss these matters, and my contact details are available at the end of the presentation, and also to discuss this with your fund managers. But it is fair to say that there is still some debate at a regulatory level on some specific features, and the case in point would be in euros and the so-called reverse distribution mechanisms.
Thank you.
So I mentioned our rating criteria a couple of times, and I just wanted to take a minute or two to say a few words about our rating criteria. And so what I put here on the slide is what we measure when we look at a money market fund. So we measure the ability of the fund to preserve principal and to provide ready liquidity. So essentially it's a double test. We're looking at both the preservation of principal and the ability of a fund to provide ready liquidity. We are going to continue rating funds in exactly the same way post-reform. So fundamentally, we base a rating on the risk that we see in the portfolio, the risk that we see in the behaviour of the fund manager, and that's going to remain the same through the reform process. We are anticipating taking rating actions on all funds as they go through the reform process, as we see that as an important way to provide information, to provide signalling to investors of our thoughts on money market funds. I should mention that our outlook for the money market fund sector in Europe is stable. So that means we are not anticipating rating changes.
I was going to say, someone's just asked the question, is the expectation cash funds will still be AAA? So
our rating outlook is stable, but obviously all rating decisions are subject to a rating committee. The other point I wanted to make here is that ratings are clearly a source of information. They can be a significant source of information to investors. And also to say very clearly that if a fund were to fail to provide liquidity, so if a fund were to gate, we would see that as a negative rating event. Quite simply, we could not look an investor in the eye and tell them that a fund is still AAA when it won't give you your money back. That just does not work for us. That is not the view of one of our competitors. S&P will maintain a money market fund rating at AAA for up to 5 days, even if the fund will not return your money to you. So we have a fundamental difference of opinion with that agency, and we have a fundamentally different approach in our rating criteria. So there is a further dimension here for corporate treasurers to be aware of, is that you have a choice in your rating agency. There are important differences in the way that rating agencies rate these funds, and you should be aware and make choices based on those important differences. And very lastly, this is our penultimate, our last. In fact, we have one polling question as well to finish. But don't forget about rates. We are coming into a rate change environment. There have been hikes already in the US, and we Fitch are actually forecasting a policy rate of 50 basis points in Europe by the end of 2019. And that could be quite significant, number one, because the portfolio managers of these funds are going to have to start earning their salaries and doing their jobs by adapting and positioning portfolios for rate changes. We think that's a good thing. But what it also does is if rates in the Eurozone do increase to a level where they become sustainably positive, then that does actually make Euro LVNAVs a viable possibility in Europe. Some of you may have heard that there is a debate over whether share cancellation or reverse distribution mechanisms are permissible under the reforms in Europe. There has been a public debate or exchange between ESMA and the legal services of the European Commission on this topic. I stress that this is a debate, and I do not think we've got the final answer yet.
Yeah, because someone's actually asking, has there been any decision yet?
Well, so far there's been a discussion, and the indication is that they won't be allowed, but that has not been finalised as yet, to the best of our understanding.
I know we at the ACT have been lobbying together with the EACT and wrote a letter voicing our concern on this.
Mm. Yeah, absolutely, and we are aware that there are many other bodies and the fund managers have been actively lobbying for this as well.
But as it stands, will fund managers be able to offer euro-denominated CNAV and LVNAV funds?
The potential...
If the treasurers out there have euro to invest.
Yeah. And there's about somewhere in the order of 100 billion euros in CNAV funds today, so it's a fairly significant amount. It would be difficult. The share cancellation mechanism would apply to the public debt CNAV funds and the LVNAV funds. So a fund manager would need to solve the issue of not being able to cancel shares.
So potentially, if a treasurer out there has euro-denominated funds, they might have to move to a VNAV fund, and then when rates become positive, effectively move again to a LVNAV or... Potentially,
yes. Or the other solution which we have heard of would be to have an LVNAV fund which has only accumulating share classes. So these are only share classes. Well, I say accumulating. I should probably invent a word at this stage and say decumulating share classes. So that would potentially be feasible. We haven't seen any launches, so we don't know how practical it would be, but potentially. How are we doing for time?
We're running short on time.
Okay. So in that case, should we have a quick vote?
Yep.
Let's have a quick vote. So second voting slide, and then we've just got a conclusion slide after this. So a rising rate environment makes what more attractive to me? CNAV government or treasury funds, LVNAV funds, short-term VNAV funds, standard VNAV funds, which are those which take the longer maturity profile, or bank deposits. So I think we gave you about 10 seconds last time. Let's give it a little bit less this time. Okay, there we go. Right, so LVNAV funds is still the winner, but deposits coming in fairly strongly there as well. Interestingly, the received wisdom in money market fund land is that money market funds respond more quickly to rate changes than deposits do. But
Just before you move on to your conclusion side, there's quite a few questions coming in on Brexit. And let me just spend 1 minute on that. I mean, the obvious answer is the questions are all to do with what impact Brexit could have on these money market funds. It will depend, obviously, on what deal the UK strikes with the rest of the EU. I mean, I guess the bad news is that fund managers may have to set up new arrangements for marketing their funds into and out of the EU and dealing with the delegation of responsibilities. But the main elements to consider for the corporate treasurers is where is the fund domiciled, where is the portfolio manager located, and where are the investors based. So I hope that answers some of those questions. Moving on to our wrap-up.
To our wrap-up. To page, I'm just going to skip back. So a few key takeaways here, and I'm not going to read through all of these, but I'm really just going to say the summary point, which is this is what you need to do. You need to understand the reforms. You need to make sure you understand how they're going to pan out, what they're going to mean, what the different types of funds that are going to be available to you, and what is the right fund for you. Corporate treasurers need to ensure that their investment policy is appropriate for now, for the reforms that are coming, and for that it gives you the appropriate amount of flexibility to consider the investment options which are right for you and right for your cash. And then lastly is to think about the rating agency that you want on the funds that you invest in, and make sure you're happy that that rating agency is going to do things like this and provide information to the market in terms of research and opinions, and also provide the information you need on the funds.
I mean that's a great slide, because you've got a lot of the key takeaways for this webinar. You've got the policy on there, the gates and fees, treasurers needing to be able to explain the changes and implications to their boards if they need to modify their policies. You've got the transition in there, and being able to answer that, actually this reform is different to the US, and we can expect a different outcome. And of course ratings. So a very good wrap-up.
And we should say that a key difference with the US is they have no LVNAV in the US.
Yes, yes.
At least
I probably wish they had, if they
well, it saved a little time.
Okay. Do you want to quickly show us the related research before I...
So here is a selection of research we've published on European money fund reform. There is a dedicated page on our website. It's all complimentary for end users, so corporate treasurers. This is free for you to use, so please go ahead and access as much as you like. And we'll be publishing more on this. And in fact, early next week we expect to publish a sort of outlook piece considering what the European money fund landscape will look like post reform.
Excellent, thank you. Well, the time has come to wrap up. As usual, we're running out of time. First, my thanks to Alistair for his excellent presentation, and also to Fitch Ratings for sponsoring this webinar. Thank you to everyone today for joining our session. I hope you found it as interesting and thought-provoking as I have. As I mentioned at the start, we will be putting up a recording of this webinar on the ACT website together with the presentation, and this will take just a couple of days. We will send you a link in due course. I'm sorry if we didn't get to your question. There's quite a few of them coming through, but I'm certain that this is not the last you're going to hear on this topic, and I do know, of course, that we are covering and featuring this topic in our upcoming annual conference in Liverpool. Finally, if you can spare a moment to provide some feedback on the webinar, we would be very grateful. Just select the feedback widget from the bottom bar. The facility to do this will remain open for a short time after the webinar ends. So that's it. Thank you very much, and goodbye.